Look at the S&P 500 futures this morning. We are hovering right around 7,210.
Yeah, and keeping in mind yesterday, the broader market closed at that record-shattering 7,519.
Right, so if you're just glancing at your dashboard before the opening bell, you probably see this, this titanium vault.
Oh, for sure. You see those numbers and assume the bulls have definitively won, the economy is invincible, and today is just going to be another effortless climb higher.
But the real risk here is that when you look at the overnight catalysts, the pre-market volume, the actual mechanics beneath those prices.
That titanium vault starts to look a lot more like a fragile pane of glass.
Exactly. The structural integrity of this market right now is riddled with microfractures.
That's precarious.
And the main overnight catalyst driving this is entirely geopolitical. We're tracking renewed, unconfirmed missile strikes in the Strait of Hormuz.
Which is essentially hijacked the implied open. I mean, we're seeing a massive Hormuz Premium instantly priced in.
So that is the mission for this deep dive. We are jumping straight into a fresh stack of high-level pre-market institutional strategy memos dated today, Wednesday, May 27, 2026.
And the tension radiating off these pages is, well, it's palpable.
Very palpable. On one hand, you have these desks tracking an absolute, undeniable AI melt-up.
Right.
But on the other, they are mapping out a massive wall of macroeconomic and geopolitical risks sitting just inches away.
Our goal for you, the active trader listening, is to decode this friction. We've got to bypass the generic financial news and uncover what the algorithmic macro funds are actually calculating right this second.
Because what they're seeing is very different from what the everyday retail investor is looking at on their phone app.
Completely different. What's fascinating here is the specific terminology these institutional desks are using to describe the overarching sentiment.
Yeah, across multiple memos, they refer to today as a Memorial Day hangover.
A hangover, right, which implies there was a wild party.
But looking at the trading volume in these notes, the participation is completely dead.
That is the paradox they're flagging. The price is high, but the conviction is incredibly low.
So low.
And a primary driver of that hesitation is what they're calling a geopolitical tug-of-war in the Middle East. It's providing this masterclass in conflicting data.
Right, because logically, the current optimism surrounding the U.S.-Iran peace talks, that should be suppressing energy prices.
It should. But clashing directly against that narrative, we have those overnight reports of the missile strikes in the Strait of Hormuz.
And to be clear for you listening, we aren't taking any political sides or making geopolitical predictions here. We are strictly analyzing how the financial architecture is pricing these events.
Strictly the data.
And right now, the algorithms are pricing in that massive Hormuz premium. Brent crude oil is pinned aggressively above $115 a barrel.
Which is a huge level. And if we connect this to the bigger picture, $115 oil is never just an isolated energy story.
No, it's a contagion mechanism.
Exactly. It's a contagion mechanism for inflation.
Yeah.
When energy costs spike, transportation costs spike, manufacturing costs spike.
Which brings us to the gravitational force dominating these pre-market memos, what the desks are universally calling Big Thursday.
Tomorrow.
We get the double feature of macroeconomic data, the second estimate of Q1 GDP, and more critically, the core PCE data.
The Federal Reserve's preferred inflation metric.
Right. The memos show traders are essentially paralyzed because the headline CPI print recently came in at a very sticky 3.8%.
They are completely unwilling to deploy new capital at all-time highs until they know the truth about that 3.8% print.
I mean, was it just a statistical blip? Or is inflation fundamentally accelerating again because of this new Hormuz premium?
That paralysis is creating an environment the European Central Bank specifically warned about in a financial stability review this morning.
Yeah, I saw that. They flagged stretched valuations.
Stretched valuations occurring inside of a volume vacuum.
Okay, we need to unpack this volume vacuum concept because reading about this, a specific analogy comes to mind.
Let's hear it.
Is the current market essentially like driving a highly tuned sports car at top speed across a frozen lake?
Oh, I like that.
I mean, the S&P is at 7,519, so the speedometer looks fantastic. We're flying. But the volume vacuum means the ice underneath the tires is dangerously thin.
That is a perfect visualization of the mechanics at play here. Price action without volume support is a structural trap.
Explain that for the listener.
Well, in a healthy market, when the S&P pushes higher on robust volume, it means thousands of diverse institutional participants are agreeing on that valuation.
They're physically buying the stock.
Right, which creates a solid foundation of bids. But when the price drifts up during a volume vacuum, It only takes a handful of small, aggressive trades to move the market higher.
Because there's no resting supply to absorb the momentum.
Exactly.
So the ice is paper thin. If a single piece of bad data drops, there are no structural buyers stationed underneath to catch the falling knife.
The car just crashes straight through. And because the broader market is essentially holding its breath on that thin ice, any capital that is moving is being hyper-concentrated.
Right, into the only sector showing reliable momentum.
Mega cap tech.
Yeah, money is actively abandoning defensive traditional sectors to blindly chase the AI melt-up.
But here is the critical twist in today's memos. The invincible darlings of the tech sector, they're starting to show pre-market cracks.
And not in their software demand, which is what everyone focuses on.
No, in their physical, real-world supply chains.
Which makes sense when you think about it. The AI revolution isn't just, code floating in the cloud. It requires physical data centers, copper wire, highly specialized semiconductors.
Real physical assets.
So let's look at the data on Nvidia, ticker NVDA. They are down 1.4% in the pre-market.
Yeah.
Now, 1.5% might not sound catastrophic to a casual investor, but context is everything here. Nvidia just reported an $81 billion revenue blowout.
Massive numbers.
They're generating historic levels of cash. CEO Jensen Huang literally just committed $150 billion annually to Taiwan to secure the Blackwell supply chain through 2027.
So with fundamentals that strong, why are institutional algorithms selling this morning?
Right. Why the gap down?
Supply chain leaks.
Yeah.
The strategy notes trace the overnight institutional selling directly to fresh intelligence, suggesting NVIDIA's next-generation GPU platform.
The Vera Rubin chips.
Yes. The Vera Rubin platform is facing a 2-month fabrication delay.
A 2-month delay. And it isn't an isolated incident either. Apple, ticker AAPL, is slumping 1.1% pre-market because separate reports indicate their inaugural iPhone Fold production timeline has slipped.
Slipped from June to August.
Okay, but wait, let me push back on this Apple narrative for a second.
Sure.
If I'm looking at this as a long-term tech investor, why does an 8-week delay on a folding phone's physical hinge matter at all?
I mean,
Isn't the entire institutional bull thesis right now built around the Apple Intelligence software cycle?
yes, the software is the holy grail right now.
Right. So if the software is what everyone actually cares about, why does a temporary hardware delay spook the smart money into selling?
Well, that's the logical consumer perspective, right?
Mm-hmm.
But institutional capital operates on a completely different set of mathematical physics.
Okay.
Hardware is the mandatory delivery mechanism for that software.
Right, you need the phone to run the AI.
Exactly. If the delivery mechanism is delayed by 2 months, the revenue realization from the accompanying software subscriptions is also delayed by 2 months.
I see.
In a normal market, that's just a minor speed bump. But at these stretched all-time high valuations, the stock isn't pricing in good execution anymore.
It's pricing in flawless execution.
Flawless. In a discounted cash flow model, a delayed dollar fundamentally reduces the present value of the company today.
So it triggers immediate programmatic profit-taking.
Instantly. They're essentially being graded on an impossibly strict curve.
That is ruthless. So if a 2-month delay is enough to trigger selling in Apple and Nvidia, what happens to the companies that actually do deliver flawlessly today?
That's where it gets interesting. The memos contrast those stumbles with 2 other tech giants this morning, Micron and Zscaler.
Let's analyze Micron first, ticker MU. They were propelled by a massive 19% surge yesterday
19%.
and officially crossed the threshold to join the $1 trillion market cap club alongside Hynix.
$1 trillion for memory chips. It's staggering.
It really is.
But it's a massive structural shift. The thesis in these memos is that the market has actually underhyped the memory constraints of artificial intelligence.
I think underhyped.
Yeah. To run these massive language models, you don't just need computing power. You need highly specialized high-bandwidth memory.
Specifically HBM4.
Right. And the data shows demand for HBM4 is so violently outstripping physical supply that Micron has transitioned from being a cyclical commodity producer
Which memory has always been.
into a secular growth monopoly.
Okay, so the pre-market strategy notes map out very specific battle lines for Micron today. The bull case target is $175.
Which requires consolidating and holding above that new $1 trillion valuation mark.
Right, but the bear case level is set at $162. And the reasoning here is fascinating.
Yeah, the analysts call that $1 trillion mark a psychological wall.
They warn there is intense retail crowding right at this level, and if the stock dips below it, momentum algorithms could instantly flip to short.
This is a classic liquidity setup.
Walk me through the mechanics of that. How does an arbitrary round number like $1 trillion trigger a violent sell-off?
So it comes down to liquidity and algorithmic triggers. Retail investors, they love round numbers.
Sure.
They place massive amounts of buy orders right at the $1 trillion market cap line because it feels historic. It feels like a safe milestone.
Before.
Right. But institutional momentum algorithms, they map out exactly where those retail orders are clustered.
They can see the order book.
They can. And if the buying pressure exhausts itself and the price slips below that psychological wall, the algorithms know the retail buyers are suddenly trapped underwater.
Oh, wow.
So the algos will instantly pivot and aggressively short the stock, essentially forcing the retail traders to panic sell.
Which accelerates the move down to that $162 bear level.
Exactly. It's weaponized math.
Weaponized math. And that algorithmic ruthlessness transitions perfectly to our next mover, Zscaler, ticker ZS.
Yeah, Zscaler.
They just reported their Q3 numbers. Huge beat on the top and bottom line, driven by enterprise cloud security.
They maintain their famous never-missed earnings streak.
Which is incredible. Proving cybersecurity is basically a mandatory expense for corporations, regardless of macroeconomic jitters.
By every fundamental metric, it was a flawless quarter.
Yet, the strategy memos flag a severe risk at the $195 level for today's session. They're explicitly warning of a post-beat fade.
Yeah, they are tracking active institutional distribution, meaning organized deliberate selling.
Despite the perfect earnings report?
Despite the perfect report.
It honestly sounds absurd. I mean, it's like taking a final exam where you study all night, you answer every question perfectly, you score 100%.
Right.
But because the teacher secretly expected you to somehow score 105%, your overall grade actually drops and you fail the class.
A post-beat fade is the exact market equivalent of that analogy.
It's wild.
You have to understand, Wall Street publishes official earnings estimates, but institutional desks trade on their own internal hidden projections.
The whisper numbers.
Exactly, the whisper numbers. The algorithms had already aggressively bought the stock over the last month, pricing in a massive historic revenue beat.
So when Zscaler only delivered a regular beat...
The models registered it as a disappointment relative to their shadow expectations.
Unbelievable.
They immediately initiate sell programs to lock in the profits they made during the run-up.
So whether a company misses because of a supply chain leak like Nvidia or beats perfectly but still faces a sell-off like Zscaler, corporate earnings are really only half the equation here.
Not even half some days.
But the real risk here, the real invisible hand dragging down these valuations, is completely detached from tech.
Yes.
The real trapdoor is hiding over in the bond market.
This is the macro overlay. And honestly, it is the analytical climax of these pre-market strategy memos.
Retail investors are entirely miscalculating the actual existential risk to the tech sector today.
They think the risk to AI is simply bad earnings.
Right. They think if a tertiary software company reports weak numbers tonight, it might pull down Nvidia.
But the institutional desks know the actual structural risk is what they call a discount rate shock.
Yeah.
You have to look at the bond yields.
The 10-year Treasury yield.
Yes.
The memos note it is currently trading around 4.47% this morning.
Which is a tactical pullback from the dangerous 4.61% highs we saw earlier this month.
Meanwhile, the dollar index, the DXY, is hovering at 99.50, heavily testing key resistance levels.
So right now, that 4.47% yield is acting as a temporary relief valve for equities.
How so?
It's mathematically lowering the discount rate for these high multiple AI tech names. It gives them the oxygen they need to run higher today, provided the yield stays suppressed below the psychological floor of 4.50%.
Okay, but there is a massive trap lurking just above that line. The memos call it the pain trade.
Specifically highlighting the duration cliff.
Let's break that down. Retail portfolios are currently massively overweight in long-duration growth stocks.
Right. And in finance, duration doesn't just mean time in the market.
No.
It refers to companies like these AI high flyers whose current stock price is almost entirely dependent on the massive cash flows they are projected to generate 5 or 10 years in the future.
Okay, so here's where the math gets really unforgiving. The memos state that if the 10-year yield spikes back up to 4.75% today,
say, driven by those inflation fears from the Middle East,
then the risk-free rate of return rises. And when the risk-free rate rises, it mathematically crushes the present value of all those future tech earnings.
It acts as pure gravitational force on valuations.
And it triggers a mechanical reaction called force degrossing.
Yes.
I want to make sure the listener truly grasps this mechanism. It's kind of like having a strict household budget, right?
Sure.
Let's say your monthly rent suddenly spikes by $1,000. That's the bond yield going up. You might be forced to sell your car to balance the books. You aren't selling the car because it suddenly has a bad engine.
Right, the car is fine.
You're selling it because it's your most liquid, valuable asset, and you urgently need the cash to rebalance your portfolio.
That's a great way to put it.
But are you telling me that a sophisticated computer algorithm will blindly dump millions of shares of a fundamentally stellar AI company just because a government bond yield ticked up by a fraction of a percent?
That is exactly the cold math of institutional risk parity.
Whoa.
Massive macro funds operate on strict, legally mandated risk ratios. They have to balance their equities against their fixed income bond portfolios.
Okay.
If the 10-year yield spikes, the value of their existing bond holdings inherently drops.
Because yields and bond prices move inversely.
Exactly. To prevent their portfolio's total risk from exceeding internal limits, the algorithms automatically and instantly sell their most liquid, profitable equity positions.
To raise cash and reduce overall market exposure.
That is the absolute essence of forced degrossing.
They sell mega-cap tech because it's their biggest winner, and they basically use it as an ATM.
Precisely. If yields move up, tech multiples are violently compressed downward. And this algorithmic purge happens regardless of how many revolutionary chips Nvidia sells this quarter.
The fundamental narrative of the company ceases to matter in that split second.
Completely. The entire market cap is held hostage by the math of the discount rate.
That is terrifying for a retail investor who's just looking at earnings growth.
It is.
So, knowing that this invisible threat of forced algorithmic selling is tied directly to the 10-year yield, we have to map out the exact mathematical triggers.
We need the lines in the sand that these institutions have drawn for today's pre-market session.
Right. We have to ground all this macro theory into immediate actionable geography for the day, because right now, the strategy memos define today's specific market conditions as a liquidity trap.
Retail FOMO,
Yeah.
the fear of missing out, is peaking exactly at the moment when institutional market makers have pulled their liquidity off the table ahead of tomorrow's inflation data.
So what are the precise levels the algorithms are targeting today?
Let's start with the S&P 500 futures, the ES.
Okay.
The memos state the ultimate line in the sand today is 7,505. That is the pivot.
So if the market can absorb early selling and hold above 7,505, the bullish trend remains intact.
Right. It sets up what traders call a gap-and-go scenario where prices open high and just keep running.
But if that thin ice cracks and prices break below 7,505,
Then yesterday's massive breakout becomes a gap and trap.
the algorithms will identify that the buyers are exhausted.
And the memos warn this would trigger a rapid liquidation target straight down to 7,435.
Because the late-coming retail bulls suddenly find themselves trapped underwater and are forced to panic sell.
Exactly. It's a cascade.
And over on the tech-heavy Nasdaq futures, the NQ, the critical line in the sand, is 22,050.
And that specific number perfectly aligns with the 9-day exponential moving average.
Wait, before we talk about breaking that level, what makes an exponential moving average different from a normal average, and why do the algos care so much about a 9-day window?
Well, a simple moving average treats every day's closing price equally.
Right.
But an exponential moving average mathematically applies more weight to the most recent trading days.
So it's far more sensitive to immediate momentum shifts.
Exactly. The algorithms use the 9-day EMA as a high-speed trigger wire for short-term trend falling. Because the Nasdaq has run up so aggressively, it has stretched far above its historical averages.
So if that 22,050 trigger wire snaps,
The memos explicitly warn of a 2% mean reversion flush down to 21,650.
let's translate that. A mean reversion flush is basically a rubber band that has been stretched too far and violently snaps back to its resting state.
That's a perfect way to describe it.
And that resting state, 21,650, is identified in the notes as an institutional liquidity pocket.
Meaning, that is the exact basement floor where the massive institutional limit orders are quietly resting.
Just waiting to buy up the retail panic on the cheap.
Basically, yeah. So if we connect this to the bigger picture, the tactical playbook for today is extreme discipline.
The institutional guidance is absolutely clear. Do not blindly chase the open.
Do not chase it. The volatility today will not be driven by news headlines about AI. It will be driven entirely by these mechanical lines in the sand.
Watch 7,505 on the S&P. Watch 22,050 on the Nasdaq.
And crucially, keep one eye glued to the 10-year yield at 4.52%.
Because if yields stay suppressed beneath that ceiling, the tech sector retains the oxygen it needs to push higher.
But what if they don't? What does this all mean for hedging?
Right. If the unconfirmed reports out of the Middle East escalate into a confirmed conflict, and the Hormuz Premium spikes oil even further, driving a resurgence of inflation terror.
Then the energy sector, specifically the XLE ETF, transitions from being a value play into a mandatory portfolio hedge.
Because in that scenario, skyrocketing energy input costs will violently drag the broader market down, while energy stocks themselves soar.
You have to maintain incredible structural nimbleness when operating inside a liquidity trap.
So to recap this intense journey we have been on this morning, we started by dissecting the friction of a Memorial Day hangover, where a geopolitical Hormuz Premium and $115 oil are quietly colliding with peak market valuations on dangerously thin volume.
We explored the physical, real-world bottlenecks in the AI supply chain, uncovering how 2-month fabrication delays for Nvidia and Apple are triggering algorithmic profit-taking.
Right, and we examine the unforgiving, flawless curves these mega-cap companies are being graded on, from the momentum triggers hiding under Micron's $1 trillion psychological wall to the shadow expectations causing Zscaler's post-beat fade.
And finally, we pulled back the curtain on the hidden mathematical trapdoor of the 10-year Treasury yield.
Where a sudden spike to 4.75% could initiate a cascading algorithmic forced degrossing event.
An event that wipes out technology gains entirely independent of how revolutionary the AI sector actually is.
It is the ultimate reminder that at this level, it is a market driven by cold mechanics, not just compelling narratives. Which leaves me with this final provocative thought for you to mull over today as you watch the opening bell.
Let's hear it.
If trillions of dollars in fundamental market value can be wiped out in an instant by algorithmic degrossing a process based entirely on the mechanical relative math of government bond yields, does genuine human conviction in a world-changing product like artificial intelligence even matter on a day-to-day basis?
That's the real question.
Or are we all just passengers in a hyper-tuned sports car strapped into a mathematical roller coaster driving blindly across a frozen lake?
That is the defining question of a fragile market structure.
Keep your eyes on those lines in the sand, watch those bond yields closely, and we will see you next time.